Welcome to Griffonomics.
It is good to be back.
Today we are dissecting a paradox, a real head-scratcher.
That's putting it mildly.
Usually, when we pull a ticker for a deep dive, we're looking at one of two things. It's either a monolith, a Lockheed, a Northrop, where the predictability is kind of the point.
Right, you know what you're getting.
Or we're looking at a garage startup. High valuation, zero product, running on nothing but hope and a really good PowerPoint deck.
Pure venture capital dream stuff.
Exactly. But today, we're looking at a company that is somehow both. It's a startup, and at the same time, it's the grandfather of its entire industry.
That is the perfect way to frame it. I mean, it's a company with a 27-year history that is currently behaving like it was just born yesterday.
For better and for worse.
In the best and worst ways possible, yeah.
We are talking about Draganfly, ticker symbol DPRO. And I have to be honest, when I first looked at the numbers for this deep dive, I thought there was a typo in the spreadsheet. I really did.
I had the same reaction.
You see a company with quarterly revenue of about, what, $2.16 million?
Which is nothing.
Let's be honest, that is a rounding error for a defense contractor. I know coffee shops in Manhattan, they'll probably pull in more than that. But then you look at the balance sheet.
And that's where the story changes.
They are sitting on a mountain of cash. Nearly $70 million. They're burning money every single month, yet they are scaling their manufacturing capacity to hit $400 million. It doesn't make sense.
It doesn't add up on paper. Not at all. Not until you understand the strategic pivot they're making.
Yeah.
If you look at this as just a standard P&L exercise, you walk away. You just close the file.
Right.
But if you look at it as a geopolitical bet,
yeah,
that's when it gets really interesting.
Okay, so that's our mission for this deep dive.
Yeah.
We need to figure out if this is just a zombie company burning through shareholder cash on some kind of pipe dream, or if we're seeing the very early stages of a massive logistical revolution in defense.
And to understand Draganfly, you have to get one thing straight. This isn't really a new tech story.
No.
No, it's a survivor story.
You called them the Elton John of the drone world in our pre-show notes.
I did.
Still standing.
And I stand by that. I mean, look, they were founded in 1998.
1998.
Think about that context for a second. That is pre-Google IPO. It's pre-iPhone. It is certainly pre-DJI dominating the world.
That is basically the Jurassic period of consumer technology.
Exactly. And then think about that big drone hype cycle we all saw around, what, 2012 to 2015?
Oh, yeah, everyone was going to have a drone.
Everyone. Do you remember Airware?
Vaguely. They were the ones who raised a fortune from Andreessen Horowitz, right? The big Silicon Valley darlings.
Hundreds of millions of dollars. Gone. Vanished. Bankrupt.
Wow.
Okay, what about 3D Robotics, Chris Anderson's company? They were going to put a drone in every garage in America.
Yeah, I remember them. They got crushed.
Crushed by Chinese manufacturing. Gone. GoPro's Karma drone. Remember that?
A recall disaster. They were falling out of the sky.
A total disaster. Discontinued.
It was a graveyard for these companies.
It was a massacre. And yet, after all of that, Draganfly is still here.
So how did they do it?
They survived because they didn't chase the consumer hype.
Yeah.
They never tried to sell selfie drones to teenagers on TikTok. They focused on the boring, difficult stuff.
The unsexy
But
market.
really unsexy markets. Industrial inspection, police surveillance, agriculture. And that survival instinct over 27 years has built a level of institutional memory that you just cannot hire for. You can't buy that.
Okay, but survival isn't growth. And we're here to talk about growth. The core mystery we had to solve today is exactly what I hinted at earlier. How does a company with $2 million in revenue justify holding $70 million in cash?
Yeah.
And why in the world are they building factory capacity for $400 million in orders that haven't even publicly materialized yet? Somebody's betting the farm here.
And that brings us right to our thesis for the day. We aren't just talking about selling flying robots. We're investigating a fundamental shift from, just selling hardware to what Draganfly calls embedded manufacturing.
Embedded manufacturing. Okay, it sounds a little bit like buzzword bingo, but I know you think this is actually the moat. This is the secret sauce.
It is the entire moat. It's all about something called the 10-day life cycle of modern warfare. And we're going to explore how Draganfly is physically embedding itself inside U.S. military bases to build weapons on demand.
So they're becoming a localized supply chain.
Essentially.
Yes. Okay, let's unpack this.
Yeah.
Because when I hear drone company, my brain still pictures, a plastic quadcopter from Best Buy. But that is clearly not what's happening here. Let's start with the hardware itself. What is actually in the Draganfly fleet?
It's a modular ecosystem, that's the key word. Think of it less like a car dealership where you buy a sedan or a truck and that's what you get. It's more like a Lego set.
Lego set, okay.
The tactical workhorse of that set is the Flex FPC.
FPV meaning first-person view.
Correct. The operator wears goggles and sees exactly what the drone sees in real time. You've seen all the footage coming out of Ukraine, that grainy video of a drone flying right into a tank turret or down into a trench.
Right, the suicide drones.
Or, the more formal term is loitering munitions.
Loitering munition is such a polite, almost sanitized way to say flying bomb.
It is. But the Flex is really interesting because of that Lego aspect we mentioned. It comes in 4-inch, 7-inch, and 10-inch configurations.
Why does the size matter so much? Why not just have one medium size that does everything?
It's all about physics and the mission profile. A 4-inch drone is tiny. I mean, it can fit in your hand. It's incredibly agile. You use that for clearing a building.
Urban warfare.
Exactly. It can fly through a doorway, zip down a hallway, and check a room for hostiles before you send a soldier in. But a 10-inch drone is a beast. It's got bigger motors, bigger props.
Okay.
You use that to carry a shaped charge and RPG warhead, essentially, to take out a light armored vehicle or a radar installation.
And the key here is that the parts are all swappable. The soldiers can do this in the field.
Yes. The arms detach. The payloads connect differently. You can turn a simple reconnaissance drone into a kinetic weapon in minutes, right there in the dirt. But the crucial differentiator, and this is really where investors need to pay attention, is that these are designed specifically for GPS-denied environments.
We hear that term a lot lately, GPS denied. Break that down for the layperson. What does that actually mean? What happens to the drone?
So in modern electronic warfare, like what we are seeing every single day in Eastern Europe, the first thing an adversary does is blast the entire radio spectrum with noise. They jam the GPS frequencies.
So we're flooding the airwaves.
With garbage signals. If you're flying a standard commercial drone, like a DJI, it relies on satellites to know where it is, to stay stable. When that signal is cut, the drone gets confused, it drifts with the wind, or it just initiates an auto-landing sequence and drops right out of the sky.
So your expensive, high-tech weapon becomes a useless paperweight in an instant.
Exactly. It's bricked. Draganfly's systems are built to fly manually or using what's called optical flow navigation. They use cameras looking at the ground to calculate their own movement, totally independent of any satellites.
So they're dumb enough to survive the jamming.
They're dumb enough to survive the jamming, but smart enough to complete the mission. That's the sweet spot.
Okay, so that's the small, fast attack dog of the fleet. What about the bigger stuff?
Then you move up to the Commander 3XL. This is the Swiss Army knife.
The utility player.
Right. It's a high-endurance quadcopter that can carry about 22 pounds, that's 10 kilograms, for roughly 20 minutes. But the design detail that matters here, and I know this is going to sound incredibly low-tech, is the flat bottom.
A flat bottom? I'm looking at the picture here in our notes.
Yeah.
It literally looks like a flying box with rotors. Why is a flat bottom a major selling point?
Because most drones are designed around the camera. The fuselage is all curved and aerodynamic. The camera is integrated beautifully into the nose. It looks sleek. It looks futuristic.
But it's a closed system.
It's a closed system. If you want to change the sensor, you have to buy a whole new drone. The Commander 3XL is a flatbed truck. It's not pretty, but it's pure utility.
Ah, I see. So it's function over form.
Precisely. You can strap anything to that flat bottom, a medical kit with blood bags to get to a wounded soldier, strap it on, a LiDAR scanner for mapping terrain for an artillery strike, strap it on, a specialized atmospheric sensor to detect chemical agents, strap it on. You don't need a new airframe, you just need a screwdriver and maybe some zip ties.
It separates the truck from the payload. That must lower the total cost of ownership significantly for the Army over the long run.
Massively. And then you have the really big one, the heavy lift drone. This is the industrial beast. It can lift 67 pounds, that's 30 kilograms, and fly for nearly an hour.
67 pounds. What are they lifting that's so heavy?
Logistics is one major use case. Moving ammunition or water or batteries to a forward position without risking a soldier walking through a minefield. But the really big application right now is mine clearing.
And mine clearing is a massive issue. I mean, we're seeing thousands of acres in Ukraine that are effectively uninhabitable for generations.
Exactly. So you hang a specialized sensor suite under the heavy lift drone. It flies a pre-programmed grid pattern, detects the mines underground, and maps them with precise coordinates. Then you can send in the disposal team, or even another drone, to detonate them safely.
It's safer, it's faster, and I imagine it's a heck of a lot cheaper than sending a platoon of guys out with metal detectors.
Night and day. And finally, there's the Outrider. This one really caught my eye because of the power source. It's a hybrid system.
Yeah, this is their big play for border security. It uses a small gas engine, think of basically a high-end lawnmower engine, to generate electricity for the electric motors.
So it completely solves the battery anxiety problem that plagues every other electric drone.
Batteries are heavy and they just don't hold enough energy for long-duration flights. We all know this from our phones. But gasoline is incredibly energy dense. Because of that little gas generator, the Outrider has a 7-hour endurance. 7 hours. That is an eternity in drone time. Most of these things fly for 20, maybe 30 minutes.
Exactly. And when you can fly for 7 hours, you aren't just replacing other drones. You are replacing helicopters. You're replacing manned patrols in jeeps driving up and down a border fence.
The economics of that must be game-changing.
It's a whole different level. You can launch this thing, have it loiter over a huge sector of the border for an entire 8-hour shift, and then land it. It's persistent surveillance.
But here's where I want to push back a little bit, because look, there are 100 drone companies out there making heavy-lift drones or FPVs. You go to any defense trade show, you'll see booths everywhere. Skydio, Teal, Brink, Parrot. What is the secret sauce here? Why Draganfly?
It all comes back to interoperability. The drone industry historically has been incredibly fragmented. You buy a small drone from company A and a big drone from company B. They have different controllers, different software, different batteries, different charging stations.
So a soldier has to learn 2 completely different complex systems.
It's a massive cognitive load, especially under stress. Draganfly has built a unified ecosystem. The Flex, the Commander, the Heavy Lift, they all share a common ground control station, or GCS. They run on the same core software.
So if I'm a 19-year-old private and I get trained on the little Flex FPV, I can reasonably figure out how to operate the giant Heavy Lift without a 2-week training course.
You have a massive head start. The muscle memory is the same. That commonality is incredibly rare. And it's not just that they build the metal, they act as a systems integrator.
What do you mean by that?
They work with other best-in-class tech companies. They're working with Paladine AI for swarming capability, so one pilot can control 10 drones at once. And they integrate sensors from companies like Smith Myers for search and rescue. They are the platform, not just the drone manufacturer.
That brings us to the services layer. Because in our outline, there's a really strong emphasis on training. Now, usually training is just a line item you throw in to sweeten a hardware deal. Buy 10 drones, get a free weekend workshop.
Yeah.
But you're saying this is a core revenue driver for them.
Draganfly is betting that the hardware is just the entry ticket. The real long-term value is in the services. They are training Air Force Special Ops and Army units not just on how to fly the drones, but on how to build and repair them in the field.
Wait a minute. They're teaching the customer how to build the product. Isn't that giving away the farm? If I teach you how to build my widget, you don't need to buy my widget anymore. You just buy the parts on Alibaba and do it yourself.
In a normal commercial market, yes, that would be absolute suicide. But in a war zone, supply chains are the first thing to break. If a rotor arm on your drone snaps during a firefight, you can't just FedEx it back to the factory in Canada and wait 3 weeks for a replacement.
You need to fix it in the Foxhole now.
You need to fix it in the Foxhole in the next 5 minutes. Draganfly is teaching them to fish because the U.S. Army demands self-sufficiency at the tactical edge.
It creates a different kind of lock-in then. You aren't hooked on the finished hardware. You're hooked on their knowledge base, their schematics, and their component supply chain.
Exactly. And they also do what's called contract engineering, or NRE, non-recurring engineering. This is a big, quiet part of their business. They do R&D for the massive defense primes. Like AeroVironment, General Atomics. So even when Draganfly isn't selling the drone with their logo on it, their engineering DNA, their circuit board design, their flight controllers is often inside the other guy's drone.
Okay, let's pivot to the strategy shift, because this is where the story goes from, small, interesting drone company to a pure play defense stock. You mentioned a revenue flip in the intro.
This is the inflection point. This is everything. Historically, Draganfly was about 70% commercial police departments, fire departments, agriculture, and 30% military. Management has explicitly said on their calls that they project this will flip.
Flip to what?
To 90% military revenue.
90%. That is a complete inversion of the business model. You are effectively firing your old customer base to chase a new, bigger one. That is incredibly risky.
It is risky, but they're following the money. And the catalyst is what their CEO, Cameron Chell, calls the shift from mechanization to automation in the Department of War.
Department of War. It's very specific, almost old-school phrasing. I mean, we've called it the Department of Defense for decades now.
He uses that phrase deliberately. It's to emphasize the kinetic nature of the business they're in. This isn't about peacekeeping, it's about fighting. And this ties directly back to that 10-day life cycle concept we teased earlier. This is the hard, brutal lesson coming out of the war in Ukraine.
Walk me through this 10-day life cycle. What actually happens in those 10 days?
So Draganfly has had boots on the ground in Ukraine since 2022. They've been delivering medical supplies, doing demining work, so they have seen this firsthand. Here's the cycle. You deploy a new type of drone. It works great. It uses a specific radio frequency, let's just say 915 megahertz for the sake of argument. For about 5 days, it's dominant. The Russians get hit by it. They don't know what it is.
Okay, so you have the advantage.
Well,
for a week.
For a moment. By day 5, the Russian electronic warfare units detect a pattern. They analyze the signal signature. By day 10, they have reconfigured their jammers to specifically block that 915 megahertz frequency, or they've tuned their air defense radar to spot that specific flight profile.
So the shelf life of a new piece of military technology is effectively less than 2 weeks.
In this domain, basically. After 10 days, that drone is obsolete. It's going to get jammed or shot down the second it takes off. Now compare that to the standard U.S. military procurement cycle.
Oh, God. The Pentagon moves at the speed of glaciers.
Yeah.
It's famous for it.
Right. It takes about 4 years on average to write a requirement for a new piece of gear, bid it out, test it, build prototypes, and finally field it. You cannot fight a 10-day adaptation war with a 4-year procurement cycle.
You will lose. It's just mathematically impossible.
Will always be 2 generations behind the enemy. So the Pentagon is too slow. We know that. How does Draganfly solve it?
The embedded solution.
This is the heart of the entire investment thesis. Draganfly isn't just shipping crates of finished drones from a factory in Saskatchewan. They are setting up manufacturing and repair lines inside or directly adjacent to U.S. and allied military bases.
So the factory's at the forward operating base. It's right there at the tactical edge.
Correct. Or it's at the main logistics hub in Poland, or at the training base back in Texas. The operational benefit of this is massive. Let's go back to that jamming scenario. The enemy starts jamming 915 megahertz.
Right. Your fleet is grounded.
In the old model, you'd radio back to HQ and say, hey, we need the new drones. You'd put in a request. You'd wait 3 months for them to ship from the U.S. In the embedded model, the soldier walks into the on-base Draganfly facility, pulls up the drone's schematic, swaps the radio module to a completely different frequency, say 2.4 gigahertz 3D, prints a new mount for it if needed, and has the entire fleet back in the air that same afternoon.
It turns the supply chain from this long, brittle, linear line into a localized, agile loop.
It's like having a 3D printer for weapons, on demand. It reduces the logistical latency from months to hours.
And just think about the business relationship that creates. It's what we were calling logistical entrenchment.
I like that term. It's perfect.
If Draganfly has their tooling, their software, their raw materials, and their technicians inside the wire on that base, and all the soldiers are trained on Draganfly's specific specs, kicking them out to bring in a competitor becomes a logistical nightmare.
The switching costs become astronomical. It's the SaaS of hardware. You're not just buying a product anymore. You're subscribing to a logistical capability. You become the default operating system for that base's entire drone warfare program.
There's another layer to this moat, though, that we have to talk about, the geopolitical angle, the dual sovereignty play.
This is absolutely critical. The U.S. government has effectively banned Chinese components, and specifically DJI drones, from all government and military fleets via the NDAA, the National Defense Authorization Act.
Right, because DJI completely dominates the commercial market. They have something like 70% of the world market. But the risk of data exfiltration is just too high for the DoD. The fear is that the drones are phoning home to Beijing.
Correct. So there is a massive vacuum in the North American market. The Army can't go to Best Buy and buy a DJI, so who fills that void? Well, Draganfly manufactures in both the U.S. and in Canada. This gives them a huge Made in North America advantage.
So they can sell under the Buy American provision.
They're fully NDAA compliant, so they qualify for U.S. defense dollars. But there is also the Buy Canadian angle. Canada has committed to increasing its defense spending to 5% of GDP. That includes a brand new $2 billion drone budget.
$2 billion. For a country with a relatively small military like Canada, that is a staggering amount of hardware they're about to buy.
It is, and Canada has very strict domestic manufacturing mandates. If the Canadian government is going to spend $2 billion on drones, they are politically obligated to buy from Canadian companies whenever possible to support local jobs. Draganfly is sitting there with a massive open for business sign on its door.
So they're effectively in a captive market in their home country of Canada, and they're in a preferred secure market here in the U.S.
It's a dual sovereignty play. It de-risks their reliance on any single government. If the U.S. budget gets delayed by Congress, they have Canada. If Canada moves slowly on a procurement, they have the U.S. Army.
Okay, so the strategy sounds robust. I'll give them that. The embedded model is clever. The 10-day life cycle thesis makes a lot of sense in the modern world, but we have to look at the cold, hard numbers. We are investors, not just tech enthusiasts. So let's look at the most recent quarter, Q3 2025.
Okay, the numbers are mixed, and that is being generous. Let's start with the top line. Revenue was $2.16 million in the third quarter. That's up about 14.4% year over year.
Which is growth, yes, but $2 million. For a publicly traded company, I have to keep coming back to this, that is tiny. That is a rounding error.
It is very small. Product sales make up about 75% of that. But the bad news, the really scary news for a traditional investor, is the bottom line. They are nowhere near profitable. They had a net loss of about $5.4 million on a GAAP basis. They are burning roughly $1.5 million in cash per month.
Okay, so small revenue, losing money every single month. If I stopped reading the report there, I'd say run away. This looks like a classic cash incinerator.
But you can't stop there, because then you get to the next line, which is the cash balance. They ended the third quarter with $69.9 million in cash on the balance sheet.
That's the anomaly. That is the one number in the whole report that makes you stop scrolling and say, wait a minute, what is going on here? Why does a company with $2 million in quarterly revenue need $70 million in the bank?
It's a war chest, for sure. But more importantly, it's a credential.
A credential? Explain that. What do you mean?
When you are bidding on major U.S. Army contracts, they audit your financials. They do a deep, deep dive on your stability. If you are a small company and you've only got 3 months of cash left in the bank, the Army will not sign a multi-year contract with you.
Because they can't risk you going bankrupt in the middle of a major deployment. It would be a disaster.
Exactly. They need to know you are going to be there in 5 years to supply spare parts and support. That $70 million cash pile is essentially a signal to the Department of Defense that says, we are stable, we are safe, we aren't going anywhere.
So they raised that money, and we should be very clear, they diluted existing shareholders significantly to do it, to essentially buy a seat at the big kids' table.
Yes, that's a great way to put it. The share count is up more than 10 times since 2023. Long-term holders have been diluted significantly. That cash pile wasn't free. It came directly out of the equity value of the early investors. But without that cash, they wouldn't even be in the room for these huge Army contracts.
Okay, let's talk about the break-even calculus. Because burning $1.5 million a month with $70 million in the bank gives them
What?
a little under 4 years of runway?
Roughly, yeah. But the goal isn't to burn through all of it. The CEO, Cameron Chell, has stated publicly that he believes cash flow break-in will happen at a revenue run rate of between $40 million and $50 million annually.
Okay. And they are currently at about an $8 million annual run rate. So they need a 5x or 6x increase from here to hit break-in. That is a very steep hill to climb.
It is. It's a huge jump. But management's argument is that they have high fixed costs right now. You know, executive salaries, public listing fees, compliance costs that are already paid for. As they scale manufacturing from $8 million to $50 million, those costs don't go up very much.
This is the classic concept of operating leverage.
Right. Once you've paid for the factory and the CEO's salary, every additional dollar of revenue flows largely down to the bottom line. So that jump from $8 million to $50 million might happen a lot faster than we think if the orders materialize.
And that is the biggest if in the world, if the orders come. So let's talk about the procurement pipeline. What is actually signed, what is real, and not just a projection.
The flagship deal, the one that everything hinges on right now, is the U.S. Army Flex FTV selection. They were officially selected to provide these tactical drone systems. But the detail here is crucial. Draganfly isn't just selling them finished drones in a box. The contract is for Draganfly to train Army personnel to assemble these units themselves on base.
So this is the pilot program. This is the first real-world test of that embedded model we talked about.
Yes. This proves that the Army is buying into the philosophy of on-site manufacturing, not just the product itself. And regarding the potential volume, the CEO dropped a number on a recent call that just blew my mind. He mentioned that a single active Army brigade in a conflict zone can consume up to 180,000 drones per month.
Whoa, stop. Did you say 180,000 per month? That sounds impossible. That sounds like a typo.
It sounds incredibly high until you reframe how you think about these things. Stop thinking of them as airplanes. Think of them as bullets. In high-intensity conflict, these FPV drones are disposable munitions. You launch them, they fly for 10 minutes, and then they blow up. You constantly need more.
It's attrition warfare at an industrial scale.
It is industrial-scale consumption. Now think about this. If Draganfly captures even 1% of that potential volume, just 1% of one brigade's needs, their entire P&L transforms overnight. It's a completely different company.
The demand is astronomical, to use their word. Okay, what else is in the pipeline?
There is a deal with the U.S. Air Force Special Operations Command, or AFSC. They're partnering with another company called Delmar Aerospace to provide foundational FPV training out at the Camp Pendleton UAS range.
So that's a foot in the door with a completely different branch of the military.
Exactly. Separate budget, separate branch, separate procurement officers. Then you have the border security play down in Cochise County, Arizona, where they're using the Outrider hybrid drone.
The so-called smart wall.
Right. Moving from boots on the ground to eyes in the sky. The total addressable market, the TAM, for that kind of surveillance is in the hundreds of millions of dollars. If the pilot program in Cochise works, it can be replicated across the entire southern U.S. border.
And what about internationally?
They recently announced an order for their Commander 3XL units from an undisclosed international military in the Asia-Pacific region. They were very careful to call it Phase 1 of a larger program.
Which heavily implies there's going to be a Phase 2, a Phase 3, and a Phase 4 if they perform well.
You'd have to assume so. And of course, their ongoing work in Ukraine gives them that combat-proven stamp of approval. That matters immensely in defense sales. If your drone worked in Kharkiv against Russian jamming, the buyer in Taiwan or Poland knows it actually works. It removes a huge amount of the technical risk for them.
Okay, so the demand seems to be lining up. The narrative is lining up.
Yeah.
But can they actually build them? You can't sell $100 million worth of drones if your factory can only build $5 million worth.
This is where Draganfly made a massive field of dreams bet. If you build it, they will come. They spent a lot of that cash they raised to increase their organic capacity, their own internal manufacturing, from about $5 million annually to $100 million annually.
They did that before they had the big contract signed.
Yes. And that is a terrifying move for a CFO, but it's an essential move for a CEO trying to win in this space. Chell was explicit about this. He said, "We wouldn't be getting this Army contract if we didn't already have that capacity." The Army doesn't award $100 million contracts to companies that promise to build a factory next year. They award them to companies that have a factory today.
That explains the cash burn then. They spent the money on the capacity ahead of time. They built the stadium, hoping the team would show up.
And they aren't stopping there. They are now partnering with large-scale contract manufacturers, like a company called Emerald, to push their total potential capacity to $400 million at the end of 2026.
A jump from $5 million to $400 million in capacity in just about 3 years. That is aggressive. That is almost reckless if the orders don't come through.
It shows you the level of confidence, or maybe the level of desperation they have to capture this market window. They truly believe the demand is coming, and they want to be the only ones with buckets big enough to catch the rain when it starts to pour.
We should also probably mention their resilience again here. It's not just about the new factory. It's about the institutional knowledge of the team.
That's a great point. Management noted on a call that only 2 engineers have left the company in decades.
That is unheard of in the tech world. In Silicon Valley, the average tenure for an engineer is, like 18 months before they jump ship for more stock options?
Exactly. That institutional memory is a huge hidden asset. They aren't relearning how to design a stable rotor every 6 months because the last guy left. They know what works. More importantly, they know what failed 10 years ago so they don't repeat the same mistakes.
Okay, so we have a company with a massive strategic pivot, a huge cash pile to fund it, and a potential explosion in orders from the world's largest customer. But we have to be realistic. This is a highly speculative play. So let's get to the final verdict. How do we even begin to value this thing?
It is absolutely a speculative value play. Let's be clear about that. Do not go out and mortgage your house to buy this stock. But let's look at the valuation gap. A good peer comparison is AeroVironment, ticker AVAV. They are the big dog in U.S. tactical drone defense. They make the famous Switchblade loitering munition.
Right. They're the gold standard in this space.
AeroVironment currently trades at roughly 6.7 times their forward sales. Draganfly, on the other hand, trades at roughly 4.9 times forward sales. So there is a discount there.
And why the discount?
Because AeroVironment is profitable, they're established, they're safe, they have a long track record of execution, Draganfly is losing money and promising future growth. The market is pricing in the enormous execution risk.
So what is the bull case? Why would you buy this?
The bull case is actually pretty simple. If they hit that $100 million in capacity utilization, or even just get close to it, the stock is massively undervalued at today's price. If that embedded model really works, it creates sticky, recurring, high-margin revenue that could last for decades. You aren't just selling drones anymore. You are running the U.S. Army's drone logistics program. You become the plumbing of the war machine.
And the bear case. What's the thing that keeps you up at night with this one?
Execution risk is number one by a mile. Scaling from 10 million to 100 million in revenue is incredibly hard. Supply chains break, quality control can slip. If they ship a bad batch of faulty drones to the Army and a soldier gets hurt because the drone failed at a critical moment, it's game over. The contract gets pulled immediately.
Reputation is incredibly fragile in the defense world.
Then there is concentration risk. If 90% of your revenue comes from the military, and specifically from the U.S. Army, you really only have one customer. If Congress decides to cut the budget, or if the Army changes its strategic mind and goes in a different direction, you are dead in the water. You live and die by the stroke of a government pen.
And we can't ignore the history of dilution?
No, you absolutely can't. If you owned this stock 3 years ago, you have been crushed by dilution. The company survived, but your personal equity in it might not have. The bet you are making now is that the painful dilution phase is finally over and the execution phase is just beginning.
It really all comes down to a bet on the future of warfare itself.
It does. It's that simple.
It's a bet on whether the Department of War really is shifting from expensive, reusable platforms to cheap, disposable, automated warfare.
And it's a bet on whether a small Canadian company can out-logistics the entire U.S. military-industrial complex by essentially building its factories inside the Foxhole.
It is a fascinating story no matter how it plays out. And before we go, I want to leave our listeners with one final thought to chew on.
What's that?
If Draganfly succeeds, if they really do teach the U.S. Army how to build its own drones in the field, do they eventually train themselves out of a job?
That is the ultimate existential question for them, isn't it?
Does the hardware become so commoditized, so simple, that the soldiers can eventually just build it themselves with generic parts they order from Amazon? Or does the software and the intellectual property, the IP, become the only thing that matters? Does Draganfly stop being a hardware manufacturer entirely and just become a software licensing company?
If they are smart, that might be the long-term plan all along. Hardware is hard, margins are low, software is infinite.
Something to think about. Risk defined, portfolio protected.
See you next time.